Okay, good afternoon. I'm Stephanie Shea, the chairwoman of the board for Asian American Chamber of Commerce, and I work for JP Morgan Chase as Business Banking Development Manager. I welcome you warmly to this great workshop, whether you are an employee or a business owner. At today's workshop, you will learn essential information on how to plan your year-end taxes and to expect for 2022. Now let me turn it over to Dr. Cindy Shao, the president and founder of Asian American Chamber of Commerce. Cindy, over to you.
Thank you, Stephanie, and thank you everyone for joining us at this special webinar on 2021 year-end tax planning. I want to first express our gratitude to CKIT for their generous sponsorship to make this event possible. And thank you everyone for taking the time to join us. And we wish everyone doing well at this special time. Chamber, we are actually pivoting our model in last 1.5 years. We hosted so many events, webinars. Now we are transitioning to hybrid events and also in-person events in past couple of months. So we look forward to seeing everyone in person. And next Thursday, we are hosting a member appreciation event. Welcome everyone to join us. It's on the website. I also want to take this opportunity to recognize our board of directors. With their strong leadership, Chamber is able to provide a strong program supporting the business in this challenging times. Also, we encourage you to consider Chamber membership if you're not a member yet. Recently, we have special membership drive in the last 2.5 months, and we are so excited to welcome almost 23 new members in the last 2+ months. So welcome to be a part of the Asian American Chamber family. Next, just a huge shout out to the Chamber sponsors. Without their support, we couldn't just run the organization and offer service. Just a few upcoming events. This is the season around the world holiday story. We're collaborating with the Virginia Hispanic Chamber and also Northern Virginia Black Chamber. So it's a special night celebration and dance, karaoke, and very diverse food. So yeah, plan to join us. Here is the our signature events. We do have a date, finalized May the 28th, 2022, and it will be held at the Live Casino. They are our title sponsor. Okay, now let's actually start the official program. We are so excited to welcome Andy Powell, tax partner at the CKIT, and also the tax manager, Rahini Janjab Butler, and they are tax experts. And at this kind of the year-end time, we are so lucky to have them sharing their knowledge, expertise, and educate about different tips on tax planning. So now, next to you, Andy and Rahini. Rahini, you would like to share your screen?
Yeah, thank you so much for giving us this opportunity to, preach what we love most, which is all things tax.
Okay.
Yeah, do you see? And I need to actually find, no, sorry.
Yeah, this looks nice.
Okay, well, there you go. So again, thank you so much for giving us this opportunity to talk to you about all things tax. As you know, the past couple of years have been a lot of moving parts, and there's still right now some things going on in Congress and what have you that's going to change things again. But so we're just going to give you as many pointers as we can on what's actually happening right now. So like I said, I'm a tax manager here at Sikich. Andy is our illustrious leader, managing partner of our office. And so hopefully whatever questions we'll be able to answer for you guys. So Andy, do you want to just give them an overview of who we are?
Sure, happy to. And again, thank you for having us today. This is really great. Just give you a little bit about Sikich itself, and it's kind of represented by this visual that you see here. We are a technology-enabled professional services firm, and we really have three main areas of services. One is compliance services, which would be the audit, accounting, and tax. We do your traditional tax returns, compliance, audits, things of that nature. On the technology side, we do help with systems themselves, ERP systems and other types of systems. And then in the advisory is where a lot of our services are, as far as like this, helping with tax planning or tax consulting. We also have a group that does transaction advisory, meaning if you're buying or selling a business. And we have a division that also helps with wealth management. So, and then similar to what Rohini was saying, our main office that we have in the DC metro area is here in Alexandria, Virginia. We've been here for almost 50 years now. So we have a long-standing relationship with the community and in the community. And we also have another office in this area in Maryland as well. So overall, there's about 45 employees that we have in the local area to assist you.
Thanks. And just to sort of add on that, one thing that I know our clients appreciate is you get the service of a small firm. You always have a main point of contact, but we have an entire firm of experts that can, like I said, provide all these services. And so you, best of both worlds, I think. So, okay, so just a brief overview of what we will discuss. We've broken it down into three main categories, business tax for, all you business owners out there, also some individual tax considerations. And then there are a few other things like, retirement planning in general, estates. And so just, a whole bunch of everything. Okay, so I'm going to just start off with our business tax updates. So one thing to first start off in discussing is, how is your business structured? I mean, there are some things that will, some deductions, for example, the manner of accounting might be similar, regardless whether you're full structured C Corp, are you a pass-through entity, or are you an individual sole proprietor? So we're going to sort of talk a little bit to try and address all those different, all three. So now, like I said, over the past couple of years, there's been some changes with the Tax Cuts and Jobs Act that ended up reducing the high corporate rate down to 21%. With that came some limitations on other deductions. So, good and bad with that. But right now it's still sitting at that rate. And it also changed the way we do some pass-through entities. And by that, I'm meaning like the partnerships, the S Corps, single member LLCs, how is that taxed? And so those are our two main focus when we're talking about the businesses. So one thing to consider as we're coming to the end of 2021 is, okay, you've got your income, you've got your expenses, other things that we can do to accelerate and, reduce your taxable net income. Or is there any way we can defer revenue? So that's great. Let's start planning now. Some of the biggest things that we talk about with that, people come to us as fixed assets. The last quarter, can you suddenly run out and buy a car? If you do, can I deduct everything? Those, again, talk to your accountant. Obviously, if you buy a whole bunch of things in the very last quarter, there are even more limits. But anyway, so those are the main things to think about right now for small businesses is what income can I defer? What expenses can I accelerate? So the biggest thing, like I mentioned, is depreciation, the use of the Section 179 and also bonus depreciation for qualified improvement properties. So Section 179 allows you to take the entire cost, and 1-year depreciation. So typically with depreciation, you take that cost and you split it over the useful life. Section 179 allows you to just expense the whole thing. There are some limitations. You talk about what is qualified property, and we can get into the nitty-gritty of that if you have questions. Around this time of year, we do get a lot of people specifically asking about vehicles, especially, the consultants that are out there. That's a huge thing for them. They do spend a lot of time in their car. So we can help with that. Now, typical passenger vehicles, go out and buy your little Lexus or Audi SUV. You might not be able to deduct the whole $50,000, $60,000 that car is going to cost. So there are limitations on that. And so we help you navigate through that. One of the biggest things is, as you know, especially when you're out and about conducting business, you do business meals. It used to be that you could deduct meals and entertainment. Entertainment now is, after the TCJA, is off the table, but meals is still limited to 50%. One of the things they took away is, when you have meals in your office to benefit your employees, you used to be able to deduct 100% of that. That was taken away, and everything was 50%. But just for 2021, the Consolidated Appropriations Act did allow that additional, 100% for those meals that are for the benefit of the employers. So basically, employers' convenience. So that's new, but that's going away. So for 2022, you'll be back down to the 50%. So another thing that we always get asked and we think is important for small businesses is setting up employee benefits. There are some, and we'll discuss a little bit later, there are some additional credits for setting up benefit plans for your employees. It's, I think, good practice and just to hire offer benefits, you can, attract good talent. But some of those is keeping in mind that when you do set those up, quite a few of those types of benefits do get to be deductible for you. So, and if you if you have a well-established firm and you're considered now a large employer, you could be penalized if you don't provide a certain level of coverage. So one of the other things, jumping ahead, is interest expense. You're limited to a deduction of 30% of your adjusted taxable income. And that, so, sorry, there is a limitation further that if you have 25 million in the past 3 years, or less than, I should say, your gross receipts of the past 3 years is less than 25 million, this 30% limitation doesn't apply to you. But that is a huge thing because you do finance so much. So you just need to, be mindful of that. Another big thing that jumps further down is net operating losses. TCJA did affect that. You used to be able to carry back. Now we cannot. And it's limited to, you can't offset full 100% of your taxable income with your net operating loss. It's currently only 80% and the balance gets pushed to future years. Okay, so here. So for pass-through entities, so that's your LLCs, your S-Corps, your partnerships, you can deduct current year losses because the way it gets taxed, that the business itself doesn't get taxed, it just flows through to the owners. So the loss, if you have a loss, is allowed, but it's limited. And you can only, so the way it works right now is just supposing you have, you're a business consultant, standalone, you single member LLC, whatever the business earns, the loss this year, but your spouse has a regular W-2 job, maybe they make $300,000, you can offset more than $250,000 of that other income to your losses. So if you have, unfortunate like $600,000 loss, you're still only going to take $250,000 in the current year. The rest does get carried forward to future years. So. And so this circling back to the business tax credits I was talking about, Those are great because they're not actually deductions. Those are, directly against your final tax liability. Biggest one that we see is research credits. Investing in the research can really help, especially if you're startup, which is basically if you have under 5 million of gross receipts, consider investing in that. So you can offset, it says here, like you can offset some of your payroll taxes with that too. Another great credit is the work opportunity credit. That it really encourages you to hire from different groups, disadvantaged groups, veterans, women, minorities, felons or ex-felons, giving them a new chance. That's a really great way to go. There's this new markets credit. So that's if you can invest in communities and you get this 39% credit. So it's like, I think that, Andy, what was the name? They used to have another name for when you went into certain communities that, like if you invested in Anacostia or something, right? That wasn't a desirable.
Yeah, they were opportunity zones is where.
Yeah, there you go. So I think this is the new iteration of that. And another and this is became very important because everyone knows, COVID changed the work landscape, but for small companies, if you offer the Family Medical Leave Act, you get a credit for the wages paid. So that's because certain smaller size companies didn't need to provide those things for their employees, but if you voluntarily do, you get credit for that. So now going on to sole proprietors. So everything that you earn gets reported on your Schedule C at your 1040. What that means is the net earnings on that, you have to pay your self-employment tax, which is basically the same, your FICA, and you pay both parts, right? Normally you're an employee, you just get your FICA and Medicare taken out. Here you're going to pay that plus the employer's portion of it. But you get a deduction for that above the line, which basically means it's just, here you're adding all your income, that you get a deduction for that. Then you get your adjustable gross income and then your other personal deductions on that. You also get, if you're a sole proprietor, 100% of your health insurance costs is an above the line. Typically other people, just it's a Schedule A item. Here you go, and that's limited. Here you get to take it above the line. Same thing for some of your retirement plan. So because you don't have an employer sponsored plan, you get to quote unquote make that a pre-tax item by making it an above the line item. And I know I'm going super fast, but Cindy, did any questions come in just on those business sections, or did you want to wait till the end?
We can wait till the end. So everyone, if you have a question, feel free to just throw that in the chat room. And after the presentation, we can take questions, but feel free to submit your question throughout the presentation. Thank you.
And if there is also something that you had recently heard and I haven't put a slide in there, again, put that in there and we'll try to get you an answer too. So, oh, sorry. Yeah, so individuals. So Tax Cuts Job Act, TCJA, reduce income rates, as some of us know, but they also just changed the structure and that we don't have the personal exemptions anymore. They narrowed some of the itemized deductions. So you have to just really look and see. In some cases, it's just made more sense to just take a standard deduction versus itemizing. Biggest one, and there's still a lot of discussion on that, some states are acknowledging, some states aren't, is the actual state income tax deduction. Used to, especially if you were a high earner, you had your payroll withholdings, you had your real estate taxes, property taxes. Now that's capped at 10,000. Still keep track of it because some states, you don't, they make further adjustments, but that was one of the biggest things to consider. There is some talk that might change, people are lobbying for that, but as of now, it's still sitting at $10,000. Mortgage interest. So that was further limited. It used to be if you had a mortgage of $1 million and under, you take the interest. And that was, but after 2017, that limitation was if your mortgage is 750,000 and less, that's fine. If it was over, which we know a lot of people in this area do probably have larger mortgages, you had to prorate that. And another thing which is a huge difference for a lot of people was the home equity loan. You used to be able to deduct the interest, but now it's still factored in with the mortgage interest, but only that portion that was used for home improvements. So a lot of people would get a home equity loan and not actually use it on their house, but go buy a car or pay for their kids' college. You have to not include that anymore. So that's a big deal, especially now if considering the lower rate. Anyway, a lot of people, because of COVID, right, we all had to work from home. We've had a lot of questions saying, well, all this additional cost, can I use my, take a deduction for business use of my home? Unfortunately, when you're an employee, you cannot. If you are, there are opportunities if you run your own business, you're, flow through entity, yes, you can, but you need to evaluate whether does it make sense? Can we shift some of those costs onto that deduction, or does it make sense to keep it all on Schedule A and deal with the limitations? But unfortunately, that's been a question I've gotten asked quite a lot. Like, oh, I had to work from home, and what about this? What about that? Unfortunately, no. If you're an employee, you cannot. Those people that do have chronic health issues and always took advantage of or tried to take advantage of medical expenses, it is now still permanently limited to 7.5%. It was 10%. So any of the excess, so it's a good thing, but keep track of it again, because oftentimes it doesn't help much, but on the state returns, it could, because they have certain other, they don't always comply. Charity has been a really big difference now that they made the standard deduction larger. A lot of people are not, it doesn't make a difference. I mean, they're giving to charity, but they don't see it. So now they did an above the line deduction. It's up to $600 for married filing jointly. So you still get the benefit of, hey, I got a deduction for giving to charity, even if you take the standard deduction. And those that are, again, because of one of the CARES Act, because of COVID, for this year, the amount, typically your charitable contribution deduction is limited to 60%, but for this year, it's 100% of yours. So if you had an adjustable gross income, and so if you're itemizing, that's fine. If you had adjustable gross income of $200,000, you could technically take the whole 200, and you gave about $200,000 in charity, you're golden. Typically, it goes down to 60% next year. So that's quite a bit. Okay, so for planning for the rest of the year, let's think about the credits. Parents get a lot of, well, they don't. There are new limitations on the child tax credit. They did increase the amount to, it used to be like $2,000 for children under 17. Now it's up to $3,000 per child under 18, but that gets phased out as you go higher your adjustable is less of a debt. Also increased and did special child credit for children under 6. And then it's still $500 for any other qualifying dependents. Like I said, ARPA did expand that. That's the American Rescue Plan Act did help out by giving more credit, but the high earners, it gets phased out. The other things that we get seen a lot for individuals is education. And one of the really good things that we see is 529s. You don't get a deduction for it on your federal return, but you do have state deductions. I think Virginia allows $4,000 per account, and you keep using that until the value of your account has been zeroed out. So is it 4,000 in Maryland as well, Andy? I can't remember. Or is it thought it was a
It's
little bit less.
$2,000 per account, per person.
Okay. Yeah. Oh, I'm gonna go back to this slide. A new thing that we've been seeing is a super funding your 529. You can make it's $75,000 or $150,000 if you're married filing joint per beneficiary. You can fund the 529. You file a gift tax return, and so you don't actually. So it's $15,000 per year. But this has been very beneficial for a couple of my clients that have done that. So they get the gift tax exclusion and further down, of course, for their estate tax. So you can do a lump sum, and it's, growth. What's good with the 529 plans, of course, is as long as whatever earnings you have in the account, as long as when you make distributions, it's all going to qualified educational purposes, you don't, the gain isn't taxed. So if you can super fund the account, you've got more upfront, more, taxable earnings and not taxable, more earnings in that account versus the, graded every year you made a contribution into that. So other educational related is the American Opportunities Credit, which is a per student max of $2,500. And then the Lifetime Learning Credit is $2,000 per tax return. Both these credits, though, just like child tax credit, do have limitations based on your earnings. So based on your adjusted gross income, they do get phased out. And the final one with the American Rescue Plan, they are allowing that student debt that is typically when debt is forgiven, it becomes taxable income to you. But until any debt that's between December 31 of last year to January 2026 will be tax-free if the debt's forgiven. So that's nice. Okay, so investments. So another hot topic question that we get is, capital gains. And as you know, that's been a big discussion in the media, ordinary income, capital gains, wealthy people aren't paying their same amount. Well, the maximum capital gains rate is 20%. And if you have more than 250,000, if you're just modified adjusted gross income, you do pay an additional 3.8% for net investment income tax. Sorry, just where was I going to go with this? So so basically it's work with your investment advisor as well as us to wonder about the timing of those gains. Do you want to pick it up now? Can you delay a sale? Flip side, also you got losses. So because once you make a trade, you get that 1099, all of it's taxable in that year. Losses, however, even if you had a huge loss, you're limited to taking a loss against ordinary income of only $3,000 per year. So that's where you work with your broker and us to decide, well, can I delay? Do I need to harvest those losses? So keep that in mind. Now there's, again, legislators are thinking about, do we change the rates? It's a huge topic around now. So keep, it may change, but as of now, maximum rate is 20% for that. All right, and then our other considerations. By that, I mean, we're talking about retirement planning and estate planning and gifting. So one of the best ways to defer tax or lower your tax liability is to max out on your, if you can, on your employer sponsored plan. So currently 401k is $19,500, and if you're over 50, you get another $6,500. If you haven't been, you can still catch up by the end of the year and put even more in there. If you don't have an employer plan, open an IRA. And I think with IRA contributions, you have until you actually file the return, the original due date of the return, right, Andy?
Correct.
Yeah. And with the retirement plans, I know this past year is tough, with 2020 and now 2021 with COVID. try and avoid taking a withdrawal from your account. It's a 10% penalty and you have to pay the tax. You can, and especially recently with the, with everything happening with COVID and people having to make emergency withdrawals, there is a 3-year plan that you can, what's the word I'm looking for? You don't pay all the tax all up front. There you go. Sorry, because typically the moment you take the withdrawal, all of that becomes taxable. Now you can spread it 3 years. Again, though, if you can avoid that, because you get a 10% penalty if you take it out before you are due, just don't do it. Best way to, if you really need the money and if you can do it, if your plan allows it, take a loan. Estate planning. So especially with people that have businesses, succession planning, factoring the value of their business into the estate. Right now, currently, you have an exclusion of 11.7 million. If you have an estate over that, you're going to pay tax at a 40% rate. Now, the TCJA is going to reduce that back down to 5 million. So in 2026. So you want to start planning for that now so that, if that does not get extended and kept at 11.7 million, you want to make sure that your estate is less than that ideally. Do you gift it? There are other ways of structuring things in trusts, but that's actually really huge because that's 11.7 million down to 5 million. That's a heck of a lot of money at 40%. And currently they're looking at making that decrease a lot sooner. So, the delicate math calculation of, okay, how much do I really need? Can I afford to give all of this away now? How do I structure that? Definitely make that plan. And that was me super speedy going through everything I think in a nutshell needs to be addressed, and the rest is learning more about our firm. Cindy, did you actually want to open it up to questions now? I think I did see 2 or 3 questions in the chat. But.
Yes, yeah, let's do that. First, I know attendees ask if we are able to share the slides with them. Are you able to share this PowerPoint slides with us so we can disseminate?
Definitely. We will be sending Cindy all these slides in PDF format that you can share.
Okay, that's so wonderful. And this is extremely informative.
There's
Thank you so much.
And as you know, there's always changes. Everyone talks about taxes and, rich people have to pay more and and the loopholes, whatever. So there's a lot to cover. So
yeah. And this question from Marja, do you all assist small businesses in creating employer-sponsored retirement plans, or is this something we can do on our own?
We can definitely assist. Andy, do we have, is it people within, I think we have people in other offices or specialists. I personally don't know that much about setting up the plan, but we definitely have contacts that.
Yeah, we can assist, I guess, kind of going down that path. The first thing would really be to determine what plan best suits your needs, whether it's a SEP, a 401k, some of the things that Rohini was talking about during the presentation. And then depending on what would be the best plan for your business, then yes, we have people in our wealth management practice that can actually help you to create the plan. In a lot of cases, what you would be doing is adopting the plan because you have to determine certain criteria, who's allowed to participate, what age do they have to be, potentially how long do they have to have worked with your organization. So there's lots of things that you would go through in the process of setting up that plan.
Mm-hmm. There are a few questions I received in the past from members, especially some nonprofit organizations. So like they want to know what's the difference between public charity and the private foundation, you know, like anything they should be aware to be compliant. And when they have like investment, right? If they invest in stock, like a donation, if they invest right in stock market or other things, anything they should be aware. It's probably too general.
No, I guess just going down some of that path. So for the investment side, what we suggest or recommend is that the organization would have some type of investment policy in place that would go through what types of investments the organization can hold, and what percentage, like what's the mix? Do you have lots of stocks, bonds, cash? What should the mix of those investments be? Really, the biggest difference between public charities and private foundations comes down to on the private foundation side, there's really a requirement depending on what the overall investment amount that's being held. There is a certain spend percentage that has to be spent on an annual basis. On a public charity side, there is no requirement as far as what has to be spent. So that's the biggest thing with the private foundations. We've actually seen over the past year, due to things with the stock market and the values going up, that a lot of the private foundations have had to increase the amounts that they've distributed, and they weren't really planning on that during the course of the year. So they've had to take on some emergency, if you will, processes to distribute the funds they need to distribute.
And Andy, isn't there, at least for the, not for the private foundations, but for the regular 501c3 public charities, there is a limitation maybe on their earnings and how much like public support percentage, the investment amounts there's a certain calculation that goes along with that too.
Yeah, that's correct too. Yes, if you were to look at the Schedule A, in the 990 filing, it goes through those things. But yeah, if you're publicly supported, you have to have at least 33 1/3% of your funds come from the public. And there is, and I don't remember off the top of my head, to
Like
Rohini's point, there is
11% or
some
something.
percentage, yeah, that you have to have that's not investment return. So
Those are fixed or maybe also they can vary. Right.
they can vary. It varies depending on what your revenue mix is within the organization.
Okay, thank you. I have a small question. Any thoughts on Roth IRA conversion? What's the maximum annual contribution to a traditional IRA? Is there any limitations? The other question we can maybe wait after you answer this.
So the Roth IRA conversions, that really comes down to planning for those conversions, because when you make that conversion, it basically is going to increase your income, and it's going to be taxed within that year you make the conversion. So we, similar to what Rohini has said about some other things, to really look at where you expect your income to be. So by doing a conversion, it's not going to throw you into a higher tax bracket. So like if you're in, let's say, a 22% bracket, you potentially would not want to do a conversion that's going to throw you into a 30% tax bracket, because you'd have additional taxes to pay. There are limitations as far as what you can contribute to traditional IRAs based on your adjusted gross income. The amount is similar. There's, correct me if I'm wrong, Rohini, I think it's $5,000 for your regular contribution, and you can do another $1,000 if you're over 55.
I believe it's 6,000 and 1,000. I think that,
Okay.
yeah.
Also, next question, your thoughts on donor advised fund and DAF, and any limitation on offsetting AGI?
Can you repeat the question? Sorry, I didn't hear the beginning.
Yeah, your thoughts on donor advised fund and any limitation on offsetting AGI?
So that comes down to where Rohini was going on the itemized deductions for individuals. So in a lot of cases, what people are looking at is what are bundling their charitable contributions. So if they see in a year that they're only going to hit the standard deduction, the $24,000 or $12,000, that they might decide not to make certain charitable contributions and bundle them together to be above that $12,000 for the standard deduction. A way to do that would be to do the donor advised funds, because with that you make the contribution to a donor advised fund and then you don't have to actually have the amount go out to charity within that year. By just making the contribution to the donor advised funds, that gives you the charitable contribution for your tax return. And then you can decide at a future time what charity or who will actually receive those donations. And then that limitation goes back to what Rohini said. In 2021, the amount's 100% of AGI. After that, it's typically 60%.
And once you put that in, you get the deduction the year you create that donor advised fund, you made that transfer. You don't get another deduction when you actually distribute from that donor advised fund. So we've had that question before.
So to set up the donor advised funds, what's involved? That's kind of just a question for nonprofit.
Usually you can work with, typically if you have an investment advisor, you can work with the investment advisor, and they usually have a program that you can set them up that way. So in most cases, what I've seen is that you're working with a company that actually has the ability to create those donor advised funds and to manage them for you.
Thank you. Thank you. Also, another question from Tony. If I'm an employee, W-2, can I open a Roth IRA?
Yes. But if you have another, like if you have a 401k, you're still limited. I mean, you can't do both. You can't max out that, and and doing a Roth IRA is great, but you're not getting a additional deduction or anything for it. You can set it up.
So far, I think that's all the questions. Did I miss other questions? Feel free to continue to post the questions. Rohini, you have more slides, right? Introducing your firms.
Yeah, this was just a detailed overview of what all our firm does. If you want to learn more about Sickage, like Andy said, we're a technology-based service provider. Main things we do, yes, accounting, audit, and tax, but we also, and by that it's, accounting. You're a new business, you need help setting up QuickBooks, you need that advice. Do you want us to do it for you, or do you want us just to help you every quarter, just making sure everything is, do I have a proper chart of account? And as you grow, we can get down to that level nitty gritty. Or if you're already established, you need someone to actually, hey, you know what, I need to do financial statements now. I'm getting bigger, I am required to. So we do all of those nuts and bolts, and of course, the tax return. Audit is huge. So, as your business grows, you may have to have a proper financial statement audit. And as long as we haven't done your bookkeeping, we'll definitely be able to do your audit. And what else do we do? And of course, tax, that's where I come in. You name it, we've probably seen it and can do it. Not just, we like, I don't want to say simple, but the vanilla flavored returns where it's just W-2, but we have, especially in this area, we personally see a lot of returns where you've got, government employees that travel the world. There's, they work for the World Bank or whatever. So we see a variety and we know how to deal with that. We've got people that have foreign investments, or they've got rental property in Maine, or so we've seen it all, and things that we don't specifically know. We have people in other offices that can give us, oh, this is the rules for this state. And so, and then with that, especially for the business clients, as you know, it's not just here, I've got a business, there's more to it, like making sure, your employee benefits plans, you need more assistance on how to create, proper human resource department. You have your business, you want succession planning, and then goes on to wealth management and estate planning. So lots of things, and ERP, the technology, and yeah, we're a full service consulting firm.
Super. We can actually have an open conversation. Anyone wants to just talk, and feel free to open your mic and then ask questions directly. And I know Andy and Rohini, they're just super experienced in tax field. Andy has over 30 years experience, and Rohini is also very experienced, right? Tax professionals serving, a variety of the industries. Rare opportunity, we have chance to ask questions directly with them. I would propose anyone, if you want to ask questions, feel free just to turn on your mic and ask them directly now. We have another 12-13 minutes.
Hey, Cindy, this is
Okay.
Tony. I have a quick question. Hi, Andy. Hi, Rohini. Thanks for the presentation. Very informative, like Cindy mentioned. So I know this question might be out there, but it's not tax related or accounting. It's more related to your technology department. Do you guys, and I see on your website, you guys do, work with the government. Do you guys do prime work for them? And if so, I was wondering if there's somebody I can reach out to in the technology department where I can talk to them about possibly, being a subcontractor.
Right now, no, we don't. On our industries that we serve, it's more government, where we're actually doing like cities and things like that, where we're auditing them or doing consulting work with them. We aren't actually, I'll say, a government contractor itself. So we do serve some government contractors, but no, the services that we provide are more of auditing local governments or assisting local governments with their internal accounting or audit needs.
Okay, great. Thanks.
So one more question. I know this also from a nonprofit, like a business organization. Basically, they also they do some they receive some donations, right, from individual, but they also give out I would say support to different smaller nonprofit. So they are wondering if this make them as like a different type of status, if they give I would say like a grant or contributions to other nonprofits. So
it really comes down to how the donations are coming to them. I won't say this is a change in the accounting pronouncements, but there has been some updates to them. And what it was previously referred to, and I'm not the expert here because of the taxes, but it's more of what they would call an agency transaction. So if the donation was like made to organization A, but it was really for or to be used by organization B, but organization A is collecting it to then distribute it to organization B, that was considered an agency transaction. So in essence, organization A would not be showing contribution revenue. They would basically be putting that on their statement of financial position or their balance sheet as a liability, because that contribution is going to be given to or paid to organization B. So that would be considered an agency transaction. So it really comes down to what is the nature of the donation and how can the donation actually be used. So if organization A has the right of variance, meaning they could vary how the contribution is going to be used, then they would therefore be able to record that as a contribution on their books, even knowing it might go to organization B. Because there's that
Mhm.
variance in it, that's what would allow that contribution to be recorded by organization A.
Well, there's so many complicated situations. Is it like actually good for them to really consult with both the attorney and tax like experts, right? In some
Yeah,
cases.
our accountants in the audit area, the compliance area, they could really help out with things of that nature. But yes, it would be really having a discussion with your attorney and with your auditor if your organization goes through an audit, so they could give you the specific guidance on what is being considered or what's being done there.
Mhm. Yeah, so now I have audience just express their appreciation. Thank you so much. Very helpful.
Just,
I-
I guess one thing before we do wind up, we didn't really include in this anything about the new tax provisions that have come out. And it's just because it was so close to doing this, and there's still lots of changes going on with the new law that's actually being called the BBB law, the Build Back Better law.
yeah.
We are having a seminar on the 23rd of November, Tuesday the 23rd. And you can go to our website and you can find the link there. But it's basically going to go through the latest about the Build Back Better Act, as well as some of the infrastructure bill and what additional things are coming up within the infrastructure bill that's out there. So again, if you want some, I'll say the latest or the most up to date, look for that on our website for November 23rd, and you'll get a lot more about the new BBB bill or act that's out there.
Well, this is brand new, right? The latest.
Correct.
It just got
update.
passed on Friday of last week.
Mhm.
Thank you, Megan, for sharing the event link. I think everyone click that, and then it's a registration already open.
Megan can pop.
Yes, registration is open and it is free for all attendees. And you also get 1 CPE credit for attending as well. And this webinar is on November 23rd. That's a Tuesday from 9 to 10 a.m.
Thank you. That's so wonderful. We can share this in our member portal too, right?
Yes.
Yeah.
Okay, do we have other questions? We have another 6 minutes.
There is a lot of stuff and a lot of moving parts, and
So you have to kind of learn every day because they're always new, right? New things.
It's been interesting the last few weeks. So.
And the last 2 years with all the changes in tax deadlines and updates with states. And so, yeah, it's been very interesting. Oh, we could mention that at this point too. Just make sure everybody is aware of Maryland and the law that was passed that allows pass-through entities, S-corps, partnerships, to actually pay the tax that is due on your profits within the state of Maryland by the pass-through entity. And what that does is that helps you with that limitation that Rohini mentioned about the $10,000 of state and local income tax. Because by taking the deduction on the corporate side, it becomes an expense. So it, in essence, helps you to increase that amount of state and local income taxes that you would be limited to of $10,000. It then increases, in essence, that amount that you're deducting by having the corporation deduct those taxes paid. So if your business is based in Maryland or does business in Maryland, that's something that you would definitely want to take advantage of.
Also, are there anything particular in DC or Virginia? that impact a business?
Virginia has not passed something similar in that nature. DC, I guess going the other way, they actually increased their tax rate for 2022. So you'd want to really kind of go the opposite way that we were talking and potentially have more income come into your return for 2021 that would be taxed at lower rates for DC versus having it come in for 2022.
Okay, thank you. Thank you so much. This is definitely extremely informative. There's so much knowledge out there, and thank you so much for sharing that with us. And we look forward to the opportunity in the future. It seems there's always something new, and business need to be aware. And yeah, without other questions.
Yeah, just
Do we have, oh yeah, we do.
okay.
Okay.
No, I just actually had the last comment that our email addresses are up here on the screen. You will have access to that. So if something does, think of a question, feel free to reach out.
And I guess to answer the question about do we advise on assets in other countries? Yes, we have specific tax professionals. Actually, we have one right here in the DC Metro office that can help as far as tax treaties and tax rates and tax ramifications as far as assets in other countries and how to transfer them to the US potentially. So yes, we do have some resources right here in the DC area for that.
Wonderful. So anything else you would like to share before there are 2 more minutes here?
No, thank you again very much for asking us to do this. And if we can help in any manner, just let us know.
Thank you so much. So we look forward to receiving the PowerPoint presentation we will share with the attendees and also our membership. Later, we can share with a bigger distribution list, over 10,000 people in our list. And thank you everyone for being with us today. If you have more questions afterwards, I guess they would welcome you to contact them. Their email is here on the screen. Again, thank you so much, everyone, and have a good rest of the day.
Thank you, Cindy. Thanks, everyone.
Thank you. Bye.
Bye-bye.